Hey there, guys. It's Scott from the Academy at CFLPA with Jason, your co-managers of the Academy. Today, we're really grateful to have Jay Seabrook, who's the co-founder of the Enriched Academy. Now, as you already know, the Enriched Academy is a very vital partner of the Academy program. But today, Jay's going to take us to another realm of financial awareness in a way that you can build a foundational value of your personal net worth over a long term in the terms of real estate. Jay, welcome to the Academy broadcast.
Scott and Jason, thanks so much for having me.
It's great to have you here. So, I'm actually taking notes here today, okay? Because what you're going to be talking about is how to use real estate as an investment. And that's just something that so many of the guys have been asking us. Everyone wants to do it, but there's a way to do it, isn't there?
Absolutely. I like myself, I've been doing real estate investing for 20 years. And we've studied real estate investing, and the goal of this session is really to try to pack, the best 45 minutes we could into this session. Like, what do you really need to know, whether, if you haven't bought your first house yet, or even if you're somebody right now that you have a few real estate investments already, like where you could walk out of this and actually really learn something that you can apply that'll have an impact. So that's the goal here.
Very cool. And I know the marketplace right now is flooded with low interest rates. A lot of people are looking to get in, but there's so much more to finding, something that will have long-term growing value for you, isn't there?
Absolutely. Yeah. So it's just, we made lots of mistakes ourselves, and we've also studied real estate investors that made lots of mistakes. And we like looking at that, because then how do we save somebody else from making those mistakes?
Yeah. And you're bringing up pain points for me, because I bought my first house at $180,000 in Peterborough. General Motors laid off their line, and I was lucky to sell it for $130,000 10 years later. I needed you, brother, a lot earlier than this, so I'm going to sit back here and learn.
Sounds good. So you want me just to get going?
That sounds great.
All right, perfect. So again, I'm a co-founder of Enriched Academy. Thanks so much for watching, everybody. And I'm going to just kind of tell you a story, I think, to kick this off when it comes to real estate investing. I really like this kid here, and we do, financial education, as a lot of you know. And this kid, about 2 years ago, we were doing an event, and it was all adults, right, for the most part. And then this kid was in the audience, so I had to go meet him. And I went up to him and just said, "Hey, man, it's really cool you came. You're like, how old are you?" And he's like, "I'm 15." And he hands me this business card. And it looks like this. So it's Tycoon Tyson. And he basically, his story was this. He's like, "Hey, I'm a real estate investor. I just bought my first house, and I have another one I'm closing on." I'm just like, what? Like, where did this kid come from? And the first thing that went through my head is like, okay, who's giving this kid money so he can go and buy his own real estate? So I asked him, I said, for starters, that's really cool. And, how did you do it? And he's like, I actually just started doing odd jobs around my house and stuff like that, and around my neighborhood when I was 9. And he started buying stuff from garage sales with his grandpa, and then he would sell it on Kijiji. So he'd buy like a phone for whatever, $50, and sell it for $150 and stuff like that. And he got to this point that he was able to buy this. This was his first house. This is in London, Ontario. That house, just so you know, in the background, it cost him about just under $100,000. He renovated it and was able to rent it to somebody where he, on top of his payments, he made $400 a month. And because he renovated it, he was able to take money out of the house and then buy another one. And he's 17 right now, and he has 6 properties. And just a cool story. So his parents put them in trust. So when he's 18 next year, all the ownership shifts to him. So that's how that works. But if you ask this kid, like, he would tell you, like, it was, it was really intimidating the first time he did it. And then I asked him, like, how was it the second time? He said it was so much easier. Like, I got the language down. And I would just say this, like, the first time you do anything or the first time you watch something like this, it's, my goal will be to try to keep you following along the whole time. But if it seems a little bit complicated sometimes, just know that that's totally normal if you haven't done this yet. But if you go through this kind of thing a couple of times, it gets so much more clear, is what we find, right? We just try to make it easy. And it doesn't matter if you're 65 or if you're 15, like this kid, the key is to get started. So
So Jay, can I ask you, at 15, you would have asked him, how did you cross that chasm of fear? Like, how did you get across that? What did the guy do? Because I know at 15, I was still thinking about my paper route, not buying houses. Like, where did he get that mindset?
A great question, Scott. I appreciate it. He's definitely a freakish kid. Like he's an outlier. You know what I mean? Like I haven't come across anyone quite like him that got started that quickly. But I can also tell you this, like we hired him at Enriched Academy for a while. And it's not like he's like a whiz kid, like a brain surgeon, like Doogie Howser or whatever kid. He's like a normal kid. But what I would say he is, though, he's just super, super curious. And that was it. And he just, you know what? He just, I think his family did help influence him, but it's not like his parents have like lots of money. They don't. I've been to their house. Like they have a normal home. His dad's a firefighter, right? And but I just say he is definitely freakishly curious. So yeah, hopefully that.
Very cool. Thanks.
Yeah. Cool. So I'll just tell you, it's like what I wanted to do is to start off with, like, how do you make money as a real estate investor? And the type of property I want to focus on in this training is where you buy residential real estate and you hold it. And versus like there's all kinds of types of real estate, like you could buy commercial properties and stuff like that, this is a bad time post-COVID to look at that stuff anyways. But I really like residential real estate. That's how most people build their wealth with real estate. And there's lots of people that have created a lot of wealth. Like the majority of wealth in this country has been created this way, right? With real estate investing. So how do you make money? So let's look at that first. And there's really two methods. And the first method, just to simplify it for you. So this is a property. This is the first property that I actually purchased. I bought this when I was 24 years old. And when I purchased, and you can see it's nothing too flashy, right? And I was able to buy it with about a 10% down payment. And I'll explain that a bit later. But I lived in the upstairs part of the house and I rented the lower part of the house. In today's dollars is $1,100. So I only lived there for 6 months. And then I basically moved out and I rented the upstairs part where I lived for $900. So the cash flow, looking at the numbers, were $2,000 of income. Now your cash flow is basically your income minus whatever you're paying to hold the property. So the first thing, the largest thing for most people is your loan. Like when you buy the house, you're not just using cash in most cases, you don't have to save up all the money. You're usually, most people are, coming up with a small down payment and then they're going to have a loan with the bank or a broker, right? So that was my payment. And then the other things I had to pay, I still have to pay because I still have this property, electricity, heat, water, insurance, property tax. So everything else was $800. So the math on it's pretty simple. It's just, reduce the $2,000 minus $1,000 minus $800. So the cash flow is what you have over and above by carrying the property, right? So pretty straightforward.
Yeah.
Now I've had that property for 18 years. So, $200 a month isn't that exciting for many people. But you look at it over more of a longer period of time and it gets more exciting. Right? So that's about what it's equated to, about $43,000 it's paid me just holding the property. Now, the second method of making money buying and holding residential real estate is your equity increase. Equity is a scary word. I'm going to try to make it, or it just sounds like, okay, what is that? I'm going to try to make it simple. But I wanted to show you this chart because it shows you back, at the bottom there, that's, down, it's 2 years, 4 years. It's going back in time in the Canadian real estate market. The US market, by the way, looks quite similar to this, a little bit different, but similar. And you can see the white bar here are how many homes are selling. So you can see how the market goes up and down. There's good and bad years. But I mean, the market's growing and it's growing in Canada and the US. And that's a good thing because there's a good amount of immigration. That really helps pull home values up. The yellow line there is showing you the home values and how they've gone up. And you can see there's ups and downs, right? And right now, just so you know, in Canada, the average home sells for about $580,000. So this is updated to the end of 2019. It's not 2020 yet, we don't have all 2020 data yet. But so there you go. So that just shows you, okay, so what this looks like. But what you really need to know is that the average home goes up about 5% in value over time. And I know there's like down markets, but if you average it out over a lot of years, that is what you'll see. That's your average number. Okay, so how did it work? How did equity increase then work on this one? This, pretty simple property. So when I bought it 18 years ago, I paid $145,000, right? And the loan on the property, I only had to come up with $15,000 of my own money to buy it, and then the bank basically paid for the rest, right? And then I had to pay them back. So the equity then was, if I sold the house, what do I have left over? Now, and that's what it was, right? So because I've just held this property over a long period of time, relatively speaking, and the mortgage is just gradually paid down. Now, technically I've paid the mortgage, but really the people that have rented from me over all those 18 years, because it's always been rented apart from a month here and there, they've basically made that payment, right? And so they paid it down from my mortgage down from 130 all the way down to 35,000. So if you look at the equity increase, it's basically what is it today versus what was it then? And you can see it's gone up 300,000. So this is where this is a much more exciting part of holding real estate. So that's $300,000. And back when I purchased this property, my income was below, I think it was below, or it was definitely below $30,000 a year. So it's kind of cool to look back on, because I wasn't even making $30,000 a year. I bought this property that's paid me like half of my income then ever since. And on average, now that's really key to say, and I want to explain that, but if you add up cash flow and equity increase, it's gone up 19,000. But this is really important to say, is that because this makes it look like crazy good. And I would say a couple of things. One, the reason it looks this good now is because I held it for a long time. The first 8 years I had this property, it almost didn't go up in value at all. And secondly, there was all kinds of, things happen. Like I've had a roof go on this property. I've had the air conditioning unit and the furnace go, where I had to pay that. I just replaced the deck last year. That was $5,000. I've had bad tenants. I had this one tenant and they wouldn't pay rent. And I remember trying to collect the rent, and they were having a really bad, month or whatever. And the person just went off the hook when I went to the house, and basically I had my brother-in-law with me. He jumped out of the car and he kind of came in hot. Next thing you know, it's about to, they have, this person had a bunch of people in their house. They all come out into the patio. It's going to be like the Jerry Springer show in about 30 seconds. Right. And that's what it looked like. And I've gone through that, and it's like, oh man, why am I even doing this? This is not worth it. So we've been through that a lot as real estate investors, and I've continued to purchase this entire time from that one property. Now I have many properties, and I can tell you that, but so how do you make it simple? As simple as you can. And what I wanted to do with you is just go through 5, that we kind of look at real estate investors. We know that we study all the books, all that stuff. What are really the key 5 things that you should know in a short period of time? And so let's go through those. So, before you start investing in real estate. So the first one would be to become a market expert. And what we recommend is that you would research and study one marketplace and then decide if you want to invest there. Now, where you live is always a good place to look as a starting point, but you might live in a major city and it's really expensive. Like I live in Vancouver. I don't invest in Vancouver. And I'll explain that to you in a bit, but I don't buy because I can't basically cash flow the property if I buy rental properties here. I actually have been buying in my old hometown. I grew up in Orillia, Ontario, for years because I could buy a property there and cash flow it. But I was really comfortable with that market. But so if it's not where you live, you could do some research. One thing you can do, just type in Google, right? And wherever, you just type in best real estate investing markets Canada. I did this recently. You could do this for the US if you're in the US right now. You're going to start getting some information. There's these Money Sense, as an example, in Canada. They do every year, this is their new listing, and they rate the different investment opportunities in Canada. And you can see their average home sale price. It doesn't mean you're paying that, by the way. Like London, Ontario, it shows here is $394 for the average house. I know there's real estate investors there still buying homes for $180, right? So this will show you how long to buy. So based on the income you make on that property from tenants, how long to buy. It shows you appreciation. It's a deeper report than I'm showing you, but that's just one thing you can do to start narrowing it down. Now, this is a really quite an exhaustive list of things that, before I went into a new market, I would dig in on this data, and this is what we recommend. And I'm not going to go through every single point here because it gets a little, but it's quite deep. But if you're interested, like screenshot this, right? Because this is a really good list, and you're also going to have the ability to access this. This is in the Academy, this whole course and all the tools I'm going to show you. But basically, you just want to go down this list. You want to actually start looking at one market. You can go on realtor.ca. You can go on the site Zillow and start to see, and you can search for like a duplex, which means there's 2 units in the house you can rent. It's really good to know like this sort of stuff in here. Like, is there like a new employer coming to town, that kind of stuff. What's been going on with how many listings there are. Like if there's right now there's a small amount of listings, it's a hot market. If there's a really large amount of listings, it's stagnant. This one of these I wanted to zoom in on is vacancy rate. And this is a really important number to know where you're going to buy. And so this just shows you this chart. This shows you the Canadian average vacancy rate is 2%. Now, what is that? So a vacancy rate shows how much of the time a rental property doesn't have anyone living there. So you can see like Regina up here has a really, relatively speaking, has a high vacancy rate. So that means it's harder to get people to rent from you there, right? And it might be putting downward pressure on the rental market. Your Canadian average is 2%. So this is just good information. Like, do you need to do this research? You don't, right? But it helps. And this is what, like, people that do this professionally, because there are people that do this, a lot of people that do this professionally, they dig in on all this stuff and they take their time and they get really smart before they go in somewhere, right? I really like the last points that you can speak with a few Chamber of Commerce, like the local business community, even speaking with local owners and residents, and even that kind of thing. It can be really powerful to better understand the particular market you're looking at. Now,
can I just ask another question there, Jay?
Yeah, please.
Because what you did is exactly what we should do. But a lot of the time people will say, just like you did, you just bought a new home in a certain place. And so guys will often hear from their teammates or friends, hey, this is the hot real estate market. And sometimes that's enough to get them looking there. What I'm hearing you say is you still got to do your due diligence. You still have to do your own research so that you become the expert and you don't take one person's opinion. Is that correct?
You got it. Yeah. I just like the smarter you can be, like, you don't want to get to a point where you're just sitting around studying it nonstop, like, and you never do anything. Like that's bad. But, but it does help. This will help you make a better choice, like the more time you spend on it. So if you went down a list like that and actually dug in and spent a few hours looking at that market, you're going to become much smarter about it. Period. You'll make a better choice because of it. So
okay.
Yeah.
And just to dovetail off that too, just to make sure everyone knows, these are tools that are at your disposal in Enriched Academy, which is immediately accessible from CFLPA.com once you're logged in. So everything you're doing here, when Jay mentions to take a screenshot, please do, because you're going to find that exact dynamic spreadsheet for you to put your own numbers into at a later date if you want to.
Yeah. Thanks for reiterating that, Jason. So everything we're going to show you here today, you can rewatch it because it's in the Academy, in the real estate investing section under Enriched Academy. So, so a couple, like I would say, so that list is cool. Like if you can go through that list. Now, even more important would be, like, if you don't want to do all that list, I would definitely speak to a realtor. So, and I would just qualify it this way. I would try, and you might need to reach out to a few. I would try to find a realtor that currently actually is a real estate investor in their own market. And what I mean by that is, it's one thing to own a house in that market. It's another thing to have rental properties in that market. If you can find that person that, hey, I got 5 properties, I've been investing here for 20 years, they are going to be insanely useful to you, that person. Their knowledge is unbelievable. The other thing is they find opportunities quicker or better opportunities. that you can invest in. So that's just a really key relationship to keep in mind. The other one is a property manager. Okay, so this is key. And if you speak to these two people, you're going to learn a lot because these people are dialed in. Now, same thing with property manager. I wouldn't just find one and then just hire them. And I'm going to explain what a property manager is because I know not everyone knows what that is. But you want to interview a few and you want to feel really good that that person is like the most experienced, they have the right price, all that kind of stuff. So a property manager, what they do is they rent properties out and manage it so you don't have to. So if you're spending half the year, traveling all over the country and playing football, you don't want to be dealing with your tenants, right? And you can't. As an example, now for me, when I bought my first property, the one I showed you earlier, I managed it. But then as I expanded the amount of properties I had, I hired somebody and I pay them between, you'll typically pay between 5 to 10% of monthly rent. That's how it usually works. I pay $50 for each door, like each apartment that my property manager manages. But that is an unbelievably good relationship. If you find a really good manager and they impress you and they, and you go with them, it is a game changer. I just wanted to say that. So the next discipline is, to me, I definitely so that checklist I showed you, very valuable. This here, I don't think you can, or you can't skip this before buying any property, even if it's just a house that you want to live in yourself and not rent, right? So you want to run the numbers and really know what the numbers are before you put the offer in on the house, right? So what we recommend is that if you're going to invest in a certain area, like one market, run the numbers on at least 5 properties before you would even attempt to buy something. And you want to put them in the Enriched Academy property analyzer. So again, this is in the CFLPA website under Enriched, in the Academy, under Enriched Academy. In the tools section, we have this tool I'm going to show you, and it's really awesome, this tool. But this is what you want to do. You want to just look at the high, basically the best return down to the lowest. And I'm just going to use an example with you. I recently bought back in July. It closed in September, so this is quite recent. I purchased this property. And I'm just going to show you how I looked at this property. So this is in Aurelia, Ontario. So it's a market I'm comfortable with. I have a really good realtor. This guy sends me listings as soon as they come up. Like the minute he gets them, he sends them out. He's been doing it for a long time. You can see the price up here in the upper right here. And you can start to see some information. Now I'll just show you some pictures. So this is what it looks like. It's a fourplex. So that means it has 4 separate units. I think it's 4 1-bedroom units is what it is. And it's a town, I'm really familiar with this town. But you can see the pictures, right? It looks really clean, looked pretty good. I was like, okay, this looks cool. Now, what I did was I asked the realtor for the income and the expense information. Okay, so you'll see the pictures and stuff and this stuff here in the listing. But it often won't have the income expense info. So I had to ask the realtor. So they sent me this, and you can see here. So 4 units, you can see the rent that they were currently collecting, the price, total rent was here. All the things that they have to pay, or I would potentially pay as the owner of the house, are all listed, right? So then what I did is I just took these numbers and I put them into that tool that I was mentioning to you. And this looks a little intense, but it's actually easier than it looks. It's called the Purchase Analyzer. You'll see it again in the Enriched backend. So all that I did is I put the address information in the upper left. I put the price. By the way, I ended up getting it for $620, not $589, because there was 5 offers on the property. So I had to bid up on it. But I just plugged in the numbers, right? Now, where you fill in numbers, you see anything here like this 496, that's auto-calculating. A lot of the numbers are going to auto-calculate. The only spot you're going to enter is purchase price here. Then you're going to put in mortgage. So I use 20% down. So I put 80%. So I had to come up with a 20% down payment to buy it. So I just put 80% here. It'll then start doing the math for you. Then I just put in my initial investment numbers. Now I knew that I would need to do an inspection on the house. That costs about $600. That's when someone goes, an expert goes in and makes, values the house. And they just make sure everything's working the way it should. And they tell you, hey, just so you know, the roof is going to go on this in a month, and that's going to cost you 10 grand. They're going to tell you that stuff so that doesn't happen to you. Anyway, so these are the things I had to pay for, including my down payment, to get the house over the line, to actually get the deal done. And the first time the second time I ever bought, the first time I bought a property, I didn't know about this stuff, right? So the cool thing about this tool is it'll show you everything that you're going to need to spend just to get the deal done. And I didn't know about land transfer tax is something, we have in Canada, in the US, and it varies depending on where you are. But if you put the province in here, it'll tell you what your land transfer tax is. As an example, it'll auto calculate that for you. It's really cool. So anyways, on this property, I could see I had to come up with $135,000 just for it to be mine, to get the keys, right? Now, further down, this is where I put all that info that I got on this sheet, all that expense info, right? And the income info, I just put it in down here. So heating, electricity. So the tenants the people that live there pay for their own electric bill. So that's why it's so low. I just have to pay for it for the laundry area and stuff like that. The water bill, all that stuff that I pay, you can see it. I just plug the numbers in, and I put my mortgage amount in, which I actually ended up getting a lower rate than that. I ended up getting 2.1. It's super low right now here. But anyway, so at 2.9, the numbers were still good. So all I did was put that in here, and it will do the math for you, right? Again, really cool. And then I just put that gross rent. So again, I took the numbers from here, including the laundry, plugged them in right here, and there it is. Now, after that, it does all the math for you. So it's really, really cool. Now, I don't want to get we get bogged down looking at the sheet for too long. If you hover your mouse over any of those red triangles that you see, it'll tell you what that is. So if you don't know what some of this stuff is, I get it. I didn't know what any of this stuff was either, not that long ago, right? But as you hover your mouse over this, it'll tell you what that stuff is. It'll make more sense to you.
Yeah.
But here's the key numbers.
Jay?
Yeah, please.
Yeah, sorry. And I know you're on a roll here. You mentioned the mortgage and the mortgage rates. Your thoughts on getting a mortgage broker, just to make sure that you, as you say, you got a better rate than what you posted there. How do you suggest players find the best mortgage, or is that something you want to cover a little bit later? Yeah,
I will address it at the end, but because you brought it up, Scott, let's talk about it. It's a really key step, because you got to find out what, I knew that I would be able to get this size of mortgage, right? I knew that because I had a broker. So I had a mortgage broker run my numbers. They look at your credit score, length of employment history, income. They look at that stuff, then they determine how much you can get. And they also look at other properties you might have. So that is an absolutely critical relationship. And it's definitely, and we actually should probably move it earlier in the course in this training, because it is a good point.
That's a question, isn't it? And a mortgage broker, we don't pay for, do we? The bank or the financial institution pays the fee. So it's really no cost to us.
That's right. Yeah, very good point. Typically, now it can vary, depending on where you're getting. The U.S. is a bit different, for sure. You'll pay 1-2% of the purchase price to the broker. Some lenders just blend it right into the mortgage. So it depends. Now, so for me, I knew I had a good broker, and I had a broker refer me to somebody else, because that broker's I can't get you the best deal. That means you got a really good broker. Guess who I'm going back to? And, nice. And he put me in RBC, right? And I used RBC because they had a special program for 4 to 6 units. That's why I used them. And I used somebody, so they were able to get me 20% down, which is great. Yeah, so good question. But here's what happened. So you can see, I ran numbers, and I put in things like property manager, repairs and maintenance. I went high on this. I threw in $4,000. Now, that's because some years you won't put almost anything into repairs and maintenance. Other years you put in $10,000. But I just knew that, hey, that's really safe. So you can see right here, these numbers in the bottom right are really, really important. And you can see the cash return. So this is cash flow positive. So that means it's not losing money every month. it's really important for me. I don't buy a property unless it is cash flow positive. And even when I kind of escalate the expenses here, then more than what they probably will be. So I'm really comfortable now with this property, and you can see the cash return. So that's just showing you on that cash flow, how much percent on your initial investment here you're getting. The mortgage pay down. So again, I'm not paying this, essentially someone other, my tenants are, they're paying this down for me. So because of that, I'm going to get 10%. So of this 135,000, I'm getting 10% right there per year. And on the value increase of the house, I just put in 3%, hoping that market will go up 3% a year. And you can see that's going to equate to 13%, because again, I'm not buying the whole house. So I'm not paying 620. I'm paying 135, if that makes sense. So I'm only tying up that much money. So this is looking at the return I get on that, on the 135, and it's 25%. Now that if you've been around investing before, that's an insanely good number.
Awesome.
And this is why we're very bullish on real estate investing, because you can get maybe 8% stock market investing on average. Doing this in Canada right now, in the US for sure, even more so honestly in the US, because your prices aren't as high, you can get that return.
A question that pops up, and you defer it to later: unique circumstances, 2020, COVID, all kinds of new forces coming to play. Do you want to address that now, or defer that to later, or just say I don't want to talk about that?
Great question. To me, it's that stuff's going on. There's always going to be something in the world. This year was extra special, let's call it. But there's always going to be something. And for me, residential real estate, commercial real estate's a bit scary right now, because there's a lot of people that aren't going to an office anymore coming up, and there's leases that haven't even expired yet that are gonna. So commercial was always, I'm always retail is way different than it used to be 5-10 years ago already. But everyone needs somewhere to live. And I was one of these tenants for years. I was one of these people that lived somewhere for years. And by the way, I wouldn't buy a property unless it's super clean, unless I can picture living there myself. And then we constantly fix them up. Right. So that's important to note. And I was one of those people for years. I was a really good tenant for a long time. So I really believe in this, in the model, for that reason. And again, but this is over a period of time, because maybe the house will go down in value. Maybe it'll go down 20 grand. Right. But guess what? Over a long period of time, I showed you earlier that you would get 5% going back 100 years in this country, 5%. Yeah. So I know 3% is quite realistic. And even if it was flat for a couple of years, this mortgage pay down is still happening.
Yeah. Right? And just, I bought a place in just north of Saskatoon 7 years ago when oil was $100 a barrel, which is oil country. The oil went flat, but the rental market was still strong. So I'm not getting property appreciation, but as you said, if you're cash flow positive, you're still getting, money back on it. So you just hang in there a little while longer.
You got it like that. And that's why, I really don't recommend buying net cash flow negative properties. You don't really know that until you run the numbers. And this thing will make sure you think of everything. That's the beauty. I don't remember this stuff. If I'm going 6 months or a year or 2 years in between buying properties, which I am, I need this thing, even though I've been doing it for years and I have a lot of properties, right? So
great.
Thanks. And again, this is built into your portal, the CFLPA portal. It's awesome. So what I would do is once you've ran the numbers on the sheet, right? And then you're way smarter, just like that. And it's not hard to get the numbers. You just reach out to email some realtors. You'll see the properties online, email them. They'll send you them. You can run your numbers. It won't even take too long. The first time it'll take you a half hour. After that, it'll start taking you 5-10 minutes to put these numbers in. And now right? And now I can make a smart choice. I've been seeing properties, just as a side note, on that market. I've been looking at them for years. And that realtor has sent me, just in the last year, probably 12 listings. I passed. I was pass. The numbers weren't that good. They were cash flow negative, whatever. Then finally, this one came along and I was jumped on it and I put the offer in right away because I knew it was such a good deal because I've been running the numbers for a while, right? And I was like, okay, that's a good deal. So once you have a property, how do you find and keep good tenants? So we'll just give you some tips. And I didn't do this stuff when I first purchased a lot of this stuff. And made mistakes basically, right? So we were trying to help you avoid mistakes. So just a few tips. It's different in every market, but if you like different local cities and towns will have their own ways to rent. Our property manager does this for us. So if you don't have a property manager, you would have to do this. But if you have a good property manager, or if you're interviewing them, I would ask them how they market properties. I would look at some examples of how they market properties, because not everyone does a good job of it. But how our property manager advertises is using Kijiji and Craigslist, right, which everyone has access to. This is just an example of a really good listing. Like there's lots of photos, there's lots of description there. And then I wanted to show you a bad example. And, you can see house for rent and high demand area. Like that's just kind of lazy. And this is your first filter. Like you're putting it out to the world. You're casting a net of potential tenants, right? And you want as many choices as possible so you can pick the best tenant, because it will change your experience as a landlord, big time. The next thing is do a background check. And in your course, so in the CFLPA portal, in the Academy and Enriched Academy, we have one of these. It's a rental application. So if you're doing this, we have one there for you that you can use. And there's some really key info on here. You got to do this and have people fill this out. You might meet somebody like, oh, I really like this person. I'll just rent to them, forget the application. I've done that and wished I didn't, right? And so there's things on here like their current employer. Like I would call that person, make sure it's for real. As an example, like if their previous landlord, call that person. You'd be surprised because you call them and they list them thinking you won't call them. And you'll call them and be like, whatever you do, don't rent to that person. I've had that happen before, right? So there's a permission for a credit check, which we recommend as well. So again, very important form to do. Make sure you get a lease, which in Ontario, as an example, there's a mandatory lease that everyone has to use, but it's different in every province. It's definitely different in the USA. But you can find really good leases online. We also actually provide a sample lease in the Academy, just so you know. So it is in there with the tools. The next discipline is make sure you run inspections. So what we mean by that is this. So you really need to look at the property. So once you get it rented, you want to actually walk through or have your property manager capture the current state of that property. So we use this thing here. And again, this is in the Academy. But it's basically, what is the current condition, right? And then if that tenant stays one time a year, our property manager will actually go through the property once a year, just to make sure everything's still in good shape. Now, I actually fly, like I'm going back soon to where we have a bunch of properties. I'm going to go with the property manager on the inspection. And even though, because I live like for where I do a lot of my investing, I'm 9 hours commute door to door away. So I don't go there too often. Like that property I showed you earlier, that fourplex, I purchased that property without being there because I have a really good property manager and I have a really good realtor. I trust both of them. That's why I did the deal. But I'm not flying there every time. But I will go and do the inspection every so often because I want to see how good, like it'll help me see how good my property manager is. And then we fix stuff like, hey, this is getting worn down. Let's repair it. Like, hey, let's redo the bathtub, whatever. And we have a checklist and we fix everything. And that keeps the pride of, rentership high. It's just, there's so many good things that happen. So you got to constantly be putting a little bit of money in, but you really got to see the properties every so often. We didn't do this at first, myself and Kevin and other investors. So we're just trying to help you avoid the same mistake because we didn't know any better. Now, this one's really important. So you want to analyze your property returns, okay? This is huge. So when you have a property and a year goes by, let's say you have a rental property, it's a condo or something, and you rented it to somebody, what was your return? And I had, like, I was teaching this, like, in a more basic way, though, to high school kids. And I had this kid ask me, and he's like, what's your real estate investing return? And I didn't know. And I felt, I was just like, oh, I got busted. Like, I actually don't know. This is years ago. And I think there's a lot of real estate investors out there like this, that you've had something for a bit, but you honestly don't really know the return you got. So we created another sheet for you. It's in the Academy again. And this isn't something you have to do too often. This is once a year. And I have a bookkeeper do this. I don't fill this stuff out, right? But I have a bookkeeper do it now. I definitely recommend you do it yourself the first time. And the way it works is this. You can see, I'll just go through the sheet. I'm going to kind of zoom in. So you can see, you just put in the address, the value of the house. This is actually a triplex that myself and Kevin Cochran, you guys, some of you would know him from Enriched Academy. We own this together. And this is the first year that we owned the house. And we've had it for, I think, like 8 or 9 years now. Now, the next area to zoom in on, see here the income. So what income did you collect each month? So this was a really good year because we had tenants every month and they all paid and it was good. These were all the expenses we had to pay. So if the tenant paid them, we wouldn't add them on here, just the ones we pay. And I want to show you one thing, because see the maintenance and repairs that year, $270, really low, just so you know. Now, the other area in the sheet is like you would just have to put in this info here yourself, anywhere it's circled here, the squares. So how much mortgage principal, so when you get a mortgage, like a loan statement, it'll tell you how much you paid down on the mortgage, how much went in interest, how much went in property tax. And then was there a home value increase or decrease? You can just estimate that if you want. We use you basically get an assessment from the government. They'll tell you if it's gone up or down once a year in most areas. Anyway, so we plug that number in here. Now, down in the bottom right of the sheet, it will calculate really some key info for you. So you can see the total income we made on the property, the value at the end of the year, the mortgage remaining. So we're typing that from the mortgage statement one time a year, and it will show you the return that you got on that property. Okay. So really key number to know, and because this will help you determine, hey, is this a good investment or a bad investment as time goes on. And I'll just show you, because the sheet will actually do many years. I want to show you the worst year so far on this property and look at it. It was this year 4. And the reason it was so bad was because of this. See the expenses?
Yeah.
So actually this year, just so you know, we spent the same on the property again. I'll just throw that, because we had to redo one of the units. Like they needed a whole new bathroom, new kitchen. So we just did that on this same property in one of the units. Anyway, that was like the worst year at the time. So that's more realistic. Like you're going to have to put, but like it's usually not that high. That's definitely higher than normal. I'd say it's averaged $5,000 for that property a year in that. But you can see our return was still pretty good. It wasn't terrible, 8.5% on the worst year. Now, so that's what the sheet looks like. And again, at the bottom, you can see where the years are. So you just one time a year, you plug the numbers in. It might take you half hour, or your bookkeeper does it for you or something. If you're doing it, it's totally worth it. Please do it. You're going to be really glad you did. Now there's a tab, it says the overview, and it's going to show you, it's got like graphs. If you don't like graphs, maybe don't look at that part, but it gives you some really good information because it looks at every year you've had it and it averages it out. And you see here, the average in this property is 18%, right? Now I want to show you something that's really important, and we didn't really get this for a long time. By the way, it'll show you return each year. So you can see year 1, that we looked at that at first, it was 32%. That's crazy good. Then it went down, and then that was the worst year that I showed you. And then it's gradually though gone down. The trend is going down. Now it's not fair because only Scott and Jason can answer this. And usually I have a huge audience. Usually there's a big audience to answer the question, but I'll throw it out to you guys. Do you guys want to guess why the number would be getting worse like that?
Jason, you go first. You're the young one.
You know what? No, I'm going to let this one pass me too.
So your equity is increasing. So it's a larger number.
Nailed it. Yeah, and usually it's a lot of blank looks, right? Because it's a lot to process quickly, so that's normal. But
so Jason gave me the answer via text. I want to let you know that, Jay, just so that I can look good. We're all good.
Well, while we're on this, though, I mean, you made a good point before, and if I'm paying attention right, your worst year thus far is 8% return, correct?
Yeah.
If you go back to your figure with the stock market, for instance, 8% is good, right? That's what you're hoping for, fingers crossed. So just, adding a little bit of fuel to the fire on this side too.
You got it. Yeah. And again, like, will it always be like that? No, like there's going to be zero return years and stuff like that for sure. This has been a really good performing property. That's why I showed it better than some other ones we have. Right. So, but you know, this like you're always going to get better than stock market pretty much as long as you manage it better, like well. And again, if you hold it over a period of time, so when the market comes down 10%, don't freak out, just hold it. Right. And we we hold basically everything. So yeah, so this just shows you the returns and really good info, right, to have. And this is what I wanted to show you because, and Scott, you said it, like the return, the number one reason the return goes down is because the equity in the property, which is like, if I sold it, what would I get, right? If I sold it, that keeps going up, okay? So because the mortgage is being paid down, so see this like in the first year when we had 32% return, the mortgage was higher, right? Then it got paid down by the tenant down to 179. So what you can do with the property is you can refinance it. And it's where you go to the bank or whoever, the mortgage broker, and say, hey, what can I refinance this for? Well, they'll give you more money, basically, on the value, on the increased value of the house. Because you can see it went from 322, now it's worth 412. They can give more money now, right? Plus the mortgage is smaller. So if we refinance this property, and so we basically, like we pull money out, and let's say in this example, so looking at these numbers, let's say I pull out 133. So I can go and buy that fourplex I just showed you, right? Which is the same amount. So I take that money out and I go buy something else, or I invest it in the stock market, or I do something fun with it, whatever. But so I pull that money out. Now the mortgage goes down to, or like now the equity goes down to 100,000. See how my return just went right back up again? So I went from, let me just go back. I went from 10.8% all the way to 25%, just like that, which is an incredible return. So anywhere, like anyone would tell you that. So, and the reason I wanted to show you that was this, is because you look at like your average stock investment, this is showing you like $100,000. And let's say you had like a financial advisor. So there's a fee you're paying them, and you come out with 7%. So your $100,000 over 20 years would grow to that. It's pretty cool. It's like, hey, it's like a lot more than what it started at. But what if you had 15%, which I'm showing you how to get that, or potentially more, right? And you can see where your $100,000 would have grown to over 20 years. And that's crazy, right? That difference like is $1.3 million more by getting that higher return. So is it worth learning this? To me, it's like, yes. But again, not for everybody, because there are like those bumps in the road, and I don't want to diminish that, because it is why I've seen a lot of people get into real estate investing. They have they have one property, then they have two, then they have three, then it becomes a huge hassle because it's too much to manage. They didn't get a property manager and they sold everything. I've seen that, right? And so I just can't emphasize that enough. There's bumps in the road, but is it worth it on a long period of time? To me, the answer is yes, but just you do need to think long term. So just final thoughts, and we'll wrap it up. But yeah, so there's my mortgage broker point, Scott. So it's a little late here in the presentation.
Sorry
We're going to change. No, it's all good. We're going to change. So again, like, hey, you want a really key thing to do is talk to a broker soon and on what you can afford. And just like a realtor, just like on a property manager, interview 3. Okay. Don't just go with the first one you talk to, because you want to see their track record, their experience. There's a huge difference between a rookie mortgage broker and someone that's been doing it for 20 years, as an example, right? So check that out. This sounds kind of bad, but you got to do this. It's remember to increase rent. And you get limited on how much rent you can increase. And I can just tell you this, as a owner of a property, your expenses go up every year, for sure. Like their electric is a little bit more expensive. Your heating bill is a bit more expensive. You know, anything that like my property manager charges a bit more or whatever, that is going to happen. That's just the way the world works. So if you have a tenant that you've had for 2 or 3 years or whatever, you never increased rent, and then 5 years goes by because they're a really good tenant, you keep them and they keep you, and you never increase the rent, it's just going to gradually erode your return. Now, it's not just cash flow you got to be worried about. It's when you try to sell the property to another investor, they're going to look at what you're getting in income. And if it's lower than it should be, that will take tens of thousands of dollars off of what you're going to sell the property for down the road. Hundreds of thousands in some cases. I'm not kidding. It's a big deal. And so you're able to increase the rent depending on where the province or state, up to a certain amount. Most are limited, but just make sure you do. And it's a very simple thing. It's just, hey, you're as per as per what's legally allowed. It's a letter system. Our property manager sends a letter out, and they know to expect it, and it's going up like dollars a year. But you got to make sure you do it. So the other thing is this. The last thing is make sure you have money aside. So even after you purchased it, make sure you have some money sitting there in an account. And it's called a staying power fund if you want to get technical about it. But it's a minimum of 1 month's total rent on that property sitting there. I like actually more like 3 months rent sitting there in cash. And the reason we do is because when you do have to replace the roof or whatever, it's not this shock, because it could be a real shock if you're not ready for that moment. And it's not if, it's when that'll happen. So, so everybody really, if you got through this far, really appreciate you hanging in. And, I hope you got some value from this. And if you ever had questions or you wanted to talk more about this, please be in touch, right? Like I'll give you my email address is jay@enrichedacademy.com, just JAY @enriched, like the word academy together.com, right? jay@enrichedacademy.com. Email me. I'd love to set up a call with you. We can talk about this. I love this. You have everything that I just showed you in the Academy, in Enriched Academy, all the tools, everything's in there, including you can see this again there too. So yeah, I think that's it, guys. Scott, Jason. Yeah.
That's incredible, Jay. I've done real estate investing for years, and I was trying not to take too many notes because I'm supposed to be watching going on here. Incredible knowledge, my friend. Thank you so much.
Wow, thanks so much for having me. Our pleasure. And anytime, guys, again, be in touch. We're here for you. And thanks so much to you for allowing us to be part of what you guys do. It's our honor to work with you guys.
Good stuff. So we're going to get this out to the membership. And again, guys, if you want to get a hold of Jay, he gave you his email address there. If you didn't catch it, you can get a hold of Jason and I at academy@CFLPA.com. And we're more than happy to hook you up with Jay because he knows a lot more about this stuff than we do. He's the one you want to talk to. Okay. All right. Any final thoughts, Jason?
I'll throw one more plug to make sure that you guys are going to CFLPA.com, logging in and making sure that you got full access to everything that Jay talked about. With a lot of great tools and making sure that you get your hands on those dynamic tools that you get to put your own numbers into. I think that's going to be a huge, huge add to your portfolios.
Yeah, it makes it real, doesn't it? Sure does. Okay, Jay, hey, from Vancouver to another Vancouverite, soon to be an Okanaganite, and Jason way out in Hamilton way. Thanks very much, guys, and we'll see you again soon. Cheers.
Thanks so much, everybody.